you get almost an 8% return from that number. Now, this is more than 5 percentage points above Treasury bonds. That's a fat premium. So stocks are just about on average valuation on a long-term historical. They're cheap relative to bonds. Again, to tell you how crazy things were back in 2000, we had a 3.3% equity real return from a 30 price earnings ratio, and you could go into 10-year tips and get over 4% guaranteed by the government real. That's an inverted ratio. Wow, it's like crazy overvalued. Nothing like that is certainly happening today. 5.8% real returns are about a 2% dividend yield. About 3.8% is going to be real EPS growth. By the way, 2/3 of that is actually caused by buybacks. Not by the real growth of the firms itself, but actually by buybacks. And that's the decomposition of the nearly 6% real return that you have. By the way, people say, well, Jeremy, is the PE ratio going to go back to 15? Not likely. We have a very different world than we had in 1870, 1900, even 1950. Don't forget, the ability to index the market has become really a gift to investors today. To maintain a cap-weighted index market portfolio, simple market portfolio in most of the 19th and 20th century would have cost you 1 to 1.5 percentage point in transactions, bid-ask, brokers' fees and everything else. Now we can all do it for 3 or 4 or 5 basis points. So really, when you take people say, well, you get 6.7%, 15 PE ratio. Well, that's like an 18-19 PE ratio today. We should expect with the liquidity of the market to have those elevated PE ratios. I estimate actually 18 to 19. Some people even come to me and think that 20 might be a new normal PE ratio. I'm not willing to go quite that far at the present time. But you can see, just staying at 17, 18, gives you between 5.5% and 6% real return on the market. Here's also, from the Bloomberg, the PE ratios. The Americas over there, you can see 2017, 2018 earnings, 2019 earnings, and you can see where basically we stand on the S&P 500. Europe is lower, 12, 13. Asia is mostly lower, and I agree. Not only is China cheap, that CSI, the Shanghai Composite Hang Seng, under 10. The whole emerging markets is cheap. And yes, I'm going to stand up here and say that. I said, well, Dr. Seigel, you said that last year. I did. I was too early. But there's 2 things that are very, very different this year. Currencies of the emerging markets are stronger. They were all under tremendous pressure last year. They have stabilized. They've hit their lows. Secondly, any of you technicians out there, take a look. Wow, we had a triple bottom in the emerging markets. Forming a base of one of the strongest bases that I have seen. And that's all beside the fact that they have an average PE ratio of 8, 9, and 10, with a dividend yield often 5%, 6%. People don't realize how high dividend yields actually are on most of the emerging market paper. I think really we've turned the corner. Can't guarantee it, but it certainly looks, I feel, I moved into the position, and yes, I moved in a little early, but I'm feeling more comfortable than I have for a long time with my position there in the emerging markets. Oh, the short cape ratio. I thought to myself, I don't have to lecture about this again. And then Fortune magazine comes out with a big article, beware cape fear and the short ratio. And then it starts out, despite what Professor Seigel says, you got to worry about this. I see Rob Arnott, who I have tremendous respect for, sitting just a few weeks ago lecturing on Bloomberg. Oh, we believe in the cape ratio. It predicts 1% real return on the U.S. Stock market over here. Well, you guys know, again, it's based on the 10-year average of past earnings. Let me just give you an update on the PE ratio that it fell really below 30 in December. I haven't updated it the last couple of weeks. It's jumped up a little bit. It is, as you can see, the mean is about 17. And as I like to point out, see that arrow, the orange arrow over there? That's when it shot up above the mean level and said the market was overvalued. Now, that was in May of 2009. I don't think that's a good call. The Dow was 8,500 at the time. I remember discussing with someone about what are some of the worst calls ever made. Well, Irving Fisher in 1929, when he went before a group of people, great economists,